The S&P 500 returned 15.42% for the month of April, and most investors didn't even make any money from it. So let me tell you why, and why this matters. So the S&P returned 15.4% for the month of April, and that is one of the most violent reversals the stock market has ever seen within 1 month. So to give you a bit of context, right, the S&P 500 returns about 9 to 10% a year on average annually. The market gave 15.4% for the month of April. Now, it's not from all-time highs, it was from lows, right? So let's explain why most investors didn't capitalize on this, because we have to understand what happened before this violent reversal, right? The stock market, or the S&P 500, didn't do anything from the period of December 2025 until February 2026, and then it suffered a 9.5% correction. This is what we call a mild correction. It's not massive, however, it was driven by a lot of uncertainty and volatility. Again, volatility created the opportunity. It was World War III narratives, the war between the US and Iran, the blockade of the Strait of Hormuz. Oil prices were spiking. Investors start getting nervous. What happens? They leave the markets, they pull their capital. Now, that is not when investors are buying. That's exactly when they should be buying, when uncertainty is high. Now, if I want to look at actual volatility, I look at the VIX, the volatility index, and that gives me an idea of the actual volatility in the market at a certain stage. And normally, the VIX usually trades at about 18, right? When we had the uncertainty towards the end of March within the market, at the peak uncertainty, we reached 35. For perspective and context, the VIX hit 59 last year with the tariff wars that Trump implemented in 2025. In COVID, the VIX hit 89, and then in the great financial crisis in 2008, the VIX hit 90. So not as big as that, right? Because it was just a mild correction. It was only 10%. But the fear was tangible and was large enough for investors not to buy any assets when they should have been buying assets, and the reversal was violent. So if you were in the market and you didn't average down on any of those prices and you didn't take an opportunity, you were just back to break even. You didn't make any money from this violent reversal. Now, second point is, when the market corrects 10%, you also have to look under the hood, right? It's not just the entire market that corrects 10%. Individual companies, especially high growth companies, what we call high beta companies, which high levered companies or smaller caps, right? They tend to correct much larger than the actual index. Their moves are much larger. So you had individual companies